In an unprecedented move, General Motors has just unleashed sweeping price cuts across its entire lineup, a decision that is sending shockwaves through the automotive industry. From the mainstream Chevy Silverado and Traverse to electric flagships, like the Blazer EV and Cadillac Lyriq, GM is slashing sticker prices by thousands of dollars, with some trims seeing reductions as high as $12,000. This isn't your average seasonal promotion or limited rebate campaign. This is a full-on pricing blitz. Sources within the dealership network report urgent memos from GM HQ, encouraging inventory liquidation at all costs. Some dealers are now offering 0% APR financing, deep manufacturer-to-dealer incentives, and lease deals that would have seemed impossible just a year ago. Even EVs, which have long carried premium price tags, are seeing massive markdowns to stimulate sales and clear stagnant inventory. GM's decision comes at a time when consumers are growing increasingly price-sensitive, and this move may mark a turning point in how America buys cars moving forward. For GM, it's not just about sales. It's about survival, relevance, and defending its place in a brutally competitive market. The big question now is, why is GM doing this? Why such a dramatic, aggressive pricing shift? The answer lies in a storm of overlapping challenges that have been quietly building for months. First and foremost, consumer demand is weakening. High interest rates, inflation-fatigued households, and growing financial uncertainty have slowed car sales significantly, especially in the mid to upper price segments where many GM models compete. Second, GM is sitting on an enormous backlog of unsold vehicles, especially electric models, that are clogging dealer lots and eating up capital. Reports show hundreds of thousands of units in inventory, with EVs like the Chevy Blazer EV and Cadillac Lyriq facing particularly sluggish sales due to a mix of high prices, charging infrastructure concerns, and stiff competition from Tesla, Hyundai, and others. Third, GM overestimated the pace of the EV transition and overproduced in anticipation of a demand boom that never came. Their factory pipelines, especially for Ultium-based EVs, are now creating more supply than the market is ready to absorb. Finally, the competition is relentless. Tesla has launched its own wave of price cuts. Ford is slashing MSRPs on the Mustang Mach-E and F-150 Lightning, and Toyota is flooding the market with more affordable hybrids and crossovers. GM is being forced to respond or risk being left behind, and they're responding with fire. For everyday consumers, this bombshell could be a golden opportunity. After years of inflated car prices, limited dealer inventory, and brutal markups, GM's price cuts are offering long-awaited relief to buyers looking for value. If you've been holding off on a new vehicle purchase, now might be your moment. Dealerships are flush with stock and motivated to sell, meaning there's room to negotiate even beyond advertised markdowns. Chevy Silverados, once averaging over $60,000 for well-equipped trims, are now being advertised in the mid-$40,000 range with incentives. Cadillac Lyriqs, GM's crown jewel EV, are now being offered below $50,000 in some markets after federal tax credits and dealer incentives. Lease offers are more competitive than ever, with some models dipping below $400 per month, a figure we haven't seen since before the pandemic. Financing deals are returning as well, with 0% offers quietly making a comeback on select models. It's a buyer's market, plain and simple. And with GM's discounts setting the tone, this may trigger a race to the bottom among competitors, giving consumers even more leverage in the weeks ahead. While consumers may cheer GM's sudden generosity, the broader implications for the auto industry are nothing short of seismic. Price cuts on this scale are rarely isolated. They create ripple effects that force rivals to respond or risk losing market share. Already, insiders at Ford and Stellantis are reportedly scrambling to assess how they'll counter GM's aggressive move. Will the Mustang Mach-E get even cheaper? Will Ram trucks start seeing new factory rebates? And what about Toyota, which has so far maintained premium pricing on its popular hybrids and SUVs? If GM manages to clear inventory and boost sales, other automakers will be under enormous pressure to follow suit, kicking off a brutal price war that could reshape the market. But there's another side to this equation: profit margins. Slashing prices means slimmer earnings per unit, And for companies already under pressure from high development costs, EV investments, and supply chain instability, this could worsen financial outlooks in the short term. Wall Street is watching closely, and GM's bold move could spook investors if revenue per vehicle continues to drop. But GM seems willing to take that risk, prioritizing volume, customer loyalty, and market dominance over immediate margin protection. It's a high-stakes play, and the entire industry may have no choice but to follow. At the heart of this dramatic move lies a critical debate. Is GM slashing prices out of desperation? Or is this a calculated, strategic reset designed to realign with consumer demand and crush the competition? The answer may be a mix of both. On one hand, GM's financials have shown warning signs: rising inventories, bloated dealer lots, and declining sales on some key nameplates. These are the classic symptoms of an automaker that needs to react, and fast. But on the other hand, GM's leadership under Mary Barra has shown a willingness to make bold, market-moving decisions. This could be GM pulling a page out of Tesla's playbook: use pricing power to dominate volume, even at the cost of short-term profitability. If GM can grab significant market share now, rebuild consumer trust, and move more EVs off the lot, they could reposition themselves as a volume leader in a post-pandemic, post-supply chain crisis world. But the risk is massive. If the gamble fails, GM could be left with even thinner margins, angry shareholders, and a weakened brand image. Either way, this price war isn't just about 2025 vehicles. It's about the future of GM itself. While GM's announcement may sound like great news for buyers, it's throwing many dealerships into chaos. Dealers across the country are grappling with rapidly changing prices, frustrated customers who bought at higher rates just weeks ago, and growing pressure to move metal fast. Some dealers are sitting on hundreds of thousands of dollars worth of inventory that's now been devalued overnight. Trade-ins are also becoming problematic. Customers are discovering that their used vehicles are worth far less than expected as resale values collapse in response to the new pricing climate. Floor plan financing costs are climbing as cars sit unsold, while service departments face fewer warranty repairs due to lower vehicle turnover in previous quarters. GM is offering some back-end support, like manufacturer-to-dealer cash, but the margins are still shrinking. Dealers now face a lose-lose situation: either sell below cost or risk carrying inventory into a slowing market. And for smaller or rural GM dealerships, this move could be financially devastating. One of the biggest culprits behind GM's price-slashing frenzy? Its electric vehicle, EV, lineup. GM bet big on the Ultium platform, investing billions in EV factories, battery plants, and new model development. But consumer demand hasn't caught up with GM's production pace. EV adoption in the US has been slower than forecasted, thanks to range anxiety, inconsistent charging infrastructure, and high sticker prices. The Blazer EV rollout was marred by software delays and lukewarm reviews. The Cadillac Lyriq, while stylish, has struggled to lure traditional luxury buyers away from Tesla and Mercedes-Benz. As a result, GM lots are overflowing with EVs that simply aren't moving. And with federal EV tax credit rules constantly shifting, customers are confused and hesitant to commit. GM is now cutting EV prices aggressively, not to dominate the market, but to offload stock before the situation becomes even worse. This is a harsh reality for GM. They jumped into the EV race full speed, but may have overshot the market's readiness. The shockwaves from GM's price cuts are already hitting the used car market. When a major automaker suddenly drops prices on new vehicles, it causes immediate depreciation across used inventory. A 2022 Chevy Traverse that held strong resale value just weeks ago now appears wildly overpriced next to its brand new, discounted 2025 counterpart. This has left both consumers and dealerships underwater on their trade-ins and certified pre-owned stock. Auction prices are falling, and some used car dealers are pausing acquisitions until the market stabilizes. For everyday drivers, this means your current vehicle is probably worth less than you think. And if you financed it during the 2021 to 2023 bubble, you may now be upside down on your loan. This domino effect is pulling down values industry-wide. From Ford to Honda to Hyundai, GM's move may have started as a bid to sell more new cars, but it's rapidly turning into a used car value implosion across the board. Investors aren't sure whether to celebrate GM's boldness or panic over its potential desperation. In the short term, stock analysts have issued mixed reactions. Some believe this is a proactive move to reset GM's inventory pipeline and prepare for a cleaner 2026 model year, particularly with their Silverado EV and Equinox EV launches looming. Others worry that slashing prices reflects collapsing consumer demand and a dangerous erosion of pricing power.